Better Money Club members. Today I'll be speaking about 5 mistakes people do before they buy their house or they buy their dream cars. Most people make these mistakes and they end up in a huge debt and they end up paying more than they should. But I don't think you should. The first mistake that people do before they buy their first house or first car is to mix the word affordability. The fact that the salesperson says you can afford this thing, or a realtor says you can afford this house, it doesn't actually mean that you can afford it. So the best thing a person could do is to get all the data they need, all the house that they say they afford, and weigh it with what they want. Because a salesperson, all they want is to make the sale so that they can get commission. Same applies to the realtor. They don't give a fuck about you. They don't care about you. So you need to understand that before you make that decision, you need to weigh your lifestyle. You need to weigh whether you can actually afford it, and does it also match with your needs. And then the second point that you need to understand in this mistake that people make is the credit score and their credit history. Your credit score is calculated based on your credit history, and it also determines whether you get high interest or low interest on your bond. So if you have a good credit score, it means you'll get much lesser interest. If you have a high credit score, it means you can get much lesser interest on your credit. But if you have a low credit score, then it means you will have a huge interest rate charged on your bond. So you need to understand the power of the credit score. So the credit score is the 3-digit number that they calculate based on your credit history, the store accounts that you had, your credit cards, whatever thing that you have involved yourself in terms of credit, it is included there. But what determines the numbers, it's how frequently were you paying the debts, it's how frequently were you able to settle your credits on time. So if you were able to do that well, then your credit score will be high. So a low credit score starts from 400 to 600, and 600 to 800 is between good and high credit score. The second mistake that people make when they buy their house, it's not having saved for a down payment. Everyone needs to know this, and it's very much important. When you are going to buy your house or your car, before you can go and do that, you must first start save towards your down payment. Your down payment is the money that is required when you buy a house and you buy a car. But sometimes you can get 100% loans that won't need you to pay the down payment. But the downside to that is that you can get yourself into trouble by getting a loan that will make you poorer and make you pay high interest rate and make you pay for longer terms. So it's important that you have saved your down payment. And another thing that you need to have saved for is the transfer fees. If you're going to buy a house, it's your lawyer's fees, so that you can be able to do that outside touching the money that you need to secure the house or the car. So it's important that you save for your down payment. My view is that if you want to buy a car or a house, you must just take a folium, researching what kind of a car you want, what kind of a car you afford, what are the benefits of the cars to you, what is the car going to bring into your life. Same applies to your house. What kind of a house that you want, what are the special things that are important, where is the location of the house that you want to buy. The third point that you need to understand is the location or the car that you want to buy. If you know the location very well, then you can be able to get a good interest on the loan, because there are certain locations where the bank consider it very high risk that even if you default in your payment, they won't be able to sell your property to the next person. Same applies to the car. The car that you want to go and buy, is it a second hand or a first hand? Mind you, the car, when you buy a car, it loses 25% of its value the minute you walk out with it on the garage. And there are certain fees and costs that are unnecessary that the dealership will try and include in the car, like the paint stuff, certain features that must be included in the car, and those are not the things that when you went there you wanted to do. So this is the mistake that people buy, and they end up paying a huge loan, a huge sum of money for something that are really not necessary. So it's important that you understand the location and you understand the features in your car that are needed. So if you understand that, you cannot make most of the mistake that people make. Fourth point is the type of the loan. It's whether it's a normal bond or it's a balloon payment. So there's a difference between the two. The balloon payment is the worst of the worst, because with the balloon payment, it means that you are going to pay your installments of the bond in lower amounts, and then the amount that you are supposed to be paid is going to be cut into half, and then they will take the other amount and put it aside, and then you will pay a lower amount. At the end of the term of paying your bond, then you will be required again to pay the remaining amount. So this can end up take long periods of repayment, and can also make the interest that they charge very high, very high, and you might even not end up reaching the final point, because it takes a long time, and it's mostly found in cars and maybe sometimes houses, but mostly in cars. You'll find a dealership saying, no, you can pay 3,000 per month on the installment. Now you think, no, 3,000 is actually not that much, and I will be also driving. So you end up taking that car, not knowing that it's a balloon payment, meaning that you'll have to pay double or double for the car, and you must also remember that the car depreciates in value over time. So you'll end up paying for two cars but driving one car that has decreased in low. Last but not least, mistakes people make when they buy their first house and cars is to think that their house is an asset or their car is an asset. It's not. It's an asset to the bank, because you are paying money to the bank, and the bank owns that property up until you fully paid it. So it's important for you to understand these most important principles. I would advocate for the house. So in order for you to turn that house into an asset, you need to be able to pay your bond quick. How can you do that? It's in the installment. You can divide your installment and pay twice per month on a fortnight basis. In that way, it will decrease the interest rate that you are supposed to pay, and it can also help you pay your bond much quicker. It means after paying your bond, then your house is an asset. But as for the car, no, it's not an asset. But unless the car, you can use it to generate other sources of income, Like on weekends, you can register on Uber Eats or register on Dr. D so that you can deliver products to people. I think Amazon is also going to add that. Thank you for watching up until this far. If you have found value in this video, don't forget to comment, leave a comment, tell us what you think, tell us what you need us to speak about in the next video or future videos. Don't forget to like, subscribe and click on the notification button below. Don't also forget to check the other content that I've been creating so that you can be able to learn more and be able to become better with money. Don't also forget to share this video with your loved ones, or share this video with a friend that you have just heard that wants to buy a car or a house. Ciao.